and the Kospi too is in the red with cuts of around 0.5%.
And on the downside, I mean, the bank nifty should not break 44,489.
Asking Sony to adhere to the merger, to withdraw this termination of the merger process.
First take on the index is red. Nifty is down about 20 odd points.
I have been generally on the positive side as far as the IT sector is concerned on the whole.
There's going to be a breathtaking pace at which we are going to introduce a few more upgrades.
EBITDA definitely will be about 20% in Q4.
Our credit cost has drastically come down to below 1%.
This week itself, we've seen once again the bank nifty fall more than the nifty.
We will be able to maintain margin, NIM of about 3.5%.
Well, that is the day so far. And you've got the market which is under pressure. We're coming to you live from the CNBC-TV18 News Online studios. The last hour of trade coming up, and it's a full house. We're just going to show you the full house in a bit. But the PNB numbers are on your screen as we speak, so it's earnings heavy, and there is a fair bit which is going on. But one thing is absolutely clear: there is a fair bit of selling pressure which has been underway. PNB up on your screen. I think as far as NPAs etc. are concerned, there is a improvement. The GNPA is down about 50 basis points quarter on quarter, and I think on the net NPA, numbers look very, very good. I mean, just under 1% compared to 1.5% the last quarter. So stocks reacting. It's up. It's moving up even as we speak. About 1.7, 1.8% higher is what we have. But well, as I said, a full house. Rima, Surabhi, Nigel.
Finally all here.
Hi, afternoon. It's the end of the week, right?
60 minutes to go.
60 minutes to go, right?
Power pack, powering through, all four of us over here. But I think, guys, one thing really stands out, and I don't want to be party pooper because that's the mood that we're getting in. But this week leaves us wondering what is going on with banks. We don't have the final word on that just yet. And the index, the bank index, or the Nifty Bank is down 3%. Nifty is down about 1.5% for the week. So I think we wrap up this week with more questions than answers, at least on that side.
I think we need to get some more clarity with regard to what the foreign institutions are doing, right? If they're not selling, then how are they adjusting the books? And that's likely to take place for the next few days as well. And the volumes are telling you this, no rocket science out there. Gross volumes extremely high out there. And that's what's put the market in a bit of a tizzy. And they have the highest exposure to banking names. So that's why you're seeing some bit of trepidation there. And in addition to that, the numbers have not been impressive. And at the start of this year, everyone was saying that it's going to be the year for the banks. So that's what caught, I think, the bulls a bit off guard. And the January jinx continues because by the look of it, we're going to end January series with a cut of around 2%. Last four January series were negative. And we maintain it. But hopefully, January 2025 will look much better.
Who remembers how February is seasonally?
It's better than January.
I'll tell you that in just a bit.
Okay. But actually, we did this piece at the beginning, at the end of last year, January, going back last 16 years, there's not been a single instance where January has been a positive, especially after having a very strong November and December. So, yeah, I mean, that is playing out. So, I mean, you can look at a lot of data points, etc. So, it's a mix of things, always is. And it is playing out right now. I just want to put out a table and just to show you the volatility that we've had. And just this week, it's a 3-day week, and there you go. From the high to the low, on Tuesday we saw a 560-point swing. Yesterday it was 350. Today it's about 200 plus so far. So volatility certainly is back. So selling pressure at higher levels. And I think on the Nifty, what one needs to watch is basically if yesterday's low once comes back into focus again, which is 21,137. It's about 140, 150 points away from where we are right now. Banks are much weaker, much more weaker. I mean, there is, momentum indicators, etc., are also indicating perhaps further downside. And there, 44,600 actually, not 44,500. 44,600 is the big retracement. We're exactly there actually. 44,605 is where we're at. That is the 61.8% retracement of the rally that we saw, 3-month rally that we saw from the lows of October to the highs of December. So we're there almost. So I think those are levels to watch out for. On the Nifty, the big support once again is 20,900, which is the 38% retracement of the rally from the lows of October. And of course, the Nifty made a high in January. 16th of January was that particular level. So that's where we find ourselves at. And earnings are not helping, right? Remind the margin. More misses than hits throughout the earnings season.
Oh, absolutely. And today it's IT being dragged down by Tech Mahindra. Tech Mahindra is down close to about 6%. The Nifty IT index is down 2%. But as the days progressed, IT continues to nurse its losses. Banks continue to trade with a cut of 1%. What's changed in the second half of the trading session is incremental selling pressure coming through in indices like pharma and FMCG. Pull up the intraday chart of the Nifty Pharma Index and the Nifty FMCG Index, and you would see the downward slide. But the problem is there's nothing really supporting our markets because all the key indices, barring the PSUs, the Nifty CPSC Index is the only one which is, holding up in the green, and that hardly has any weightage. But all the big sectors, banks down 1%, IT is down 2%. You've got, a cut of over 1% in healthcare and FMCG. And autos, it's been quite the tale of two cities. Bajaj Auto has now moved to the high point of the day, a gain of nearly 5%, while TVS Motors continue to nurse big losses of close to about, down 3%.
And we don't have the best of mid-cap earnings. When large mid-caps, look at HPCL. IOC was, such a bumper, but then HPCL comes in, disappoints. We've had a couple of other numbers as well. IGL is down about 6% as we speak. So that was another disappointment. And then, after market hours yesterday, your list is pretty long. DCB, etc. So on the mid-cap side, we've had more misses than hits. And I think that's just adding to the sense of, discomfort, perhaps.
Well, that's right. But from the low of the day, at least we've seen a bit of a bounce, right? At one point of time, we had gone down to around 21,250 approximately. So there is a bit of a bounce that we're seeing from the day's low. And the bulls will not want to visit that level yet again. But we're closer, actually, to the lower end as we speak, 180 points lower. How do you position yourself, though, for the final hour of trade? And how is the rollover shaping up? Well, we have Nagraj Sethi, the technical research analyst who joins us on the show. Hi, Nagraj. Good afternoon and good to see you in. Well, what's your view? These bounces are getting sold into and the volumes on the downside are rather large. Your view, what are the levels you're looking at and how would you trade the index?
Yeah, hi, good afternoon. Rightly said, Nifty has been showing a high volatility. What we are observing recently in the last 8-10 sessions is Nifty is finding a strong resistance at the lower highs. Sharp selling pressure is emerging from the lower highs. This is what exactly happened today and a few days back as well. So I'm expecting that trend remains weak on every rise. There is a possibility of selling pressure emerging. If Nifty sustains some bounces in the next 1 or 2 sessions, it moves up, then there is a
Nagraj, I think
coming down from 21,500 at the lower levels. And if the Nifty breaks below the support of 21,100, I'm expecting this to move down to.
Okay, I think we have a bad line with you, Nagraj. We're going to try and fix that audio, not able to hear the levels clearly. So we'll just patch the line again. We'll come back to you on the trades. Let's see if we can actually go across to Sonal on some of those big oil and gas names that have come out. And both have disappointed, like I was saying. HPCL, it's no follow-through after its peer did a great job yesterday. And likewise for IGL. Let's take it one at a time, Sonal, starting with HPCL. What led to the miss here?
It was a surprising miss that came by for HPCL, especially as you mentioned, IOC reported good set of numbers during market hours yesterday itself. And that's why a sharper knock that we're seeing on HPCL, because the expectation was that maybe, like IOC, HPCL would report good numbers as well. But it is a top-down miss that we are seeing on HPCL, led by the refining segment and the marketing segment as well, because remember, HPCL has the highest exposure to the marketing segment. So the revenues, they're up 16%, but EBITDA is down 74% on a quarter-on-quarter basis, which is lower than the poll of 3,500 crore rupees. The margins have come in at 1.94%, which compares with the poll of 3.65%, and the net profit is down 90% on a quarter-on-quarter basis to come in at 529 crore rupees. Their refining throughput was down around 7% on a sequential basis. Their marketing sales, however, were higher on a YOY and on a quarter-on-quarter basis, so that's where the company did slightly better. Now we get the GRM number as well. It is $8.50 per barrel versus a poll of around $15.50 per barrel. So it is lower. There has been a decline here that the company has seen versus IOC, which actually saw an improvement there. The implied marketing margins, this is as per ICICI Securities, for the quarter stood at 4,707 rupees per ton versus an estimate of 6,753 rupees per ton. So that's again where a disappointment has come. And blended retail margins for petrol and diesel stood at 2.8 rupees per litre. So it is a miss both on refining and marketing, which is surprising considering the peer did well yesterday.
Speaking of misses, that's a big miss from SBI Life. Before we talk about IGL, let's just pull up the other big stock. They've missed on VNB, value of new business. They've missed on the VNB margin number as well. Though the top line number, the APE number looks fine, but there's a bit of a disappointment there on the VNB and the margin side. But Sonal, back to you. IGL, what happened here?
It was a miss on EBITDA. The EBITDA per unit is much lower than what the street was working with. And surprisingly, MGL reported numbers day before yesterday and it was an EBITDA beat. So looks like it is the same story again for city gas distribution companies as well. The volumes, they are in line with what the street was working with. Let me take you through the numbers. The revenues are up 3% on a sequential basis, but the EBITDA is down 14%. It was expected to decline, but it is more than what the street was working with. Margins at 15.9% and profits are down 27%. The EBITDA per SCM or the EBITDA per unit has come in at 7.2 rupees per unit. The poll was of 8.5 rupees per unit, so it's a big decline there. The total volumes at 8.48 MMSCMD is in line with estimates of 8.5 MMSCMD. Now, why is this EBITDA number disappointing? Because it's the lowest that we've seen in last 3 quarters. This is because of lower APM gas allocation that IGL got. But again, it's surprising because MGL did a beat on margins and IGL did not, and it is more expensive than MGL in terms of valuations. Trades at around 20 times, MGL trades at around 13 times. So that's why this big disappointment and the stock is at the lows of the day.
Okay, thank you very much for that. Dipan Mehta, director at Elixir Equities, is with us on the show. Dipan, where do you stand on IGL versus MGL? As Sonal pointed out the numbers, MGL stock has outperformed IGL. In the last 1 year, MGL is up 60% while IGL is absolutely flat. Despite that, there is that valuation comfort which MGL provides. So between the two, which one would you bet on?
Good afternoon, Ima, and thank you for having me on your show. I think IGL has got a better footprint and they're getting into some of the newer geographies. So definitely, I think growth prospects of IGL are better, which is why the street is paying a higher valuation multiple. But broadly, I think, these gas distribution companies, they're like utilities. And the more we see electrification, not only of private vehicles, but also public transportation, it's going to affect the long-term volumes of these companies. So I'd be a bit circumspect in the entire gas distribution space. And by and large, I think on the whole, also the market also looking a bit dicey at this point of time. So companies where the numbers are not up to expectation could be targeted first to kind of lighten up the positions.
Okay, all right. Dipan, I know cement is not your favorite. I'm not sure whether you had a chance to look at the results of ACCA, but those numbers actually look very, very good. I'm just taking a look at it. We were working with a 7 to 8%, and most on the street were working with a high single-digit growth in terms of volumes. They've come in with a 16.5 to 17% growth out there. Valuation-wise, ACC is one of the cheapest stocks in the larger cap, cement companies. Now, the profitability as well has come in at more than 1,000 rupees. So these numbers look good. Good top-line growth, benefit of lower pet coke prices as well have played out here. What's your view on the stock? Valuation-wise, you're getting a large cement company at close to around, $100, $110 per ton. Your take?
Yeah, Nigel, you're right. I think we have been negative on cement, but no doubt last couple of quarters, the performance has been exceptionally good across the board. And not just ACC, I think Ultratech, JK Cement, and a lot of other companies came with very good set of numbers. You could see this trading rally in cement continue for maybe one more quarter or so. Our only issue with cement is that massive capacity is coming on stream over the next 2-3 years or so. And whether the industry can, sell so much of cement and whether the country can absorb this much of cement needs to be seen. So I'm a bit circumspect from that point of view. And all the benefits of lower raw material prices have already got priced in, and it's being reflected in the numbers as well. And right now, also, if you look at the return ratios of all the cement companies, they are in that 10, 11, 12% kind of a range. And once more and more capex goes on stream, that ratio may even come down further. So given that this is a low return on equity business and so much of capacity is coming up in the near future, I'd like to not pay a very high PE multiple. So I'm a bit circumspect over the longer term, medium to long term prospects of cement. But there's no doubt that there's a nice short term trading rally playing out in all cement shares. And it could be the outperformer for this quarter.
Okay, that's a word on cement coming in. Deepan, hi, good afternoon. Let's come back to the central question, and that is banks, right? That's what we've been spending most of our hours discussing over the past couple of days. So what is your sense right now in terms of the selling that large cap banks are having to absorb? About 8% on Axis, for instance, this week, another 3% down on HDFC Bank this week. Do you think we're close to the bottom, or what is the overhang?
No, I'm not sure whether we are close to the bottom. And I think the numbers across the board were very disappointing. Pre-provisioning profits, which is the key number, is about 10-11% for large banks, negative for a few banks like Axis Bank. And it's just that lower provisioning and higher other income could be treasury profits have resulted in the earnings per share still sustaining around about 18 to 25% growth for many of the banks. But base effect also will fast catch up, and therefore the NPA benefit in terms of lower costs also may vanish. And unless there is an improvement in the liquidity in the banking system, which is something which only the RBI can do, I think banks will remain in under a bit of a cloud. And I do not see any inflection point, as I said, unless the kind of net interest margin starts to ease off, which can only happen once the deposit rates try to cool off and these companies are able to raise more deposits. So it's a bit of a challenging time for banks. It's not that the long-term fundamentals of the industry have been impacted. I think if you are positive on the Indian economy, you can't be negative on banks. But I think that they may have a challenging quarter or two.
Have you ever looked at the numbers of Realtel? The stock has done very well, 250% up in the last 1 year. It listed about 3 years ago with an issue price of, I think, 94, 96. And now it's at 450 rupees. And the numbers are looking good, a 47% jump in the company's revenues year on year. And the company's been consistently reporting decent numbers. So have you tracked Realtel? Do you have a view on the stock?
Yeah, Rima, while you're talking, there's rights also, RITES, which is up 17%. I think these are great times for railway stocks, and unfortunately, we missed them. But there's great earning visibility because of the order book they're sitting on. And there is no letting up on spending as far as railways are concerned. And with the budget round the corner, traders always feel that railways, again, some more numbers, even higher investment may be announced. So these are great time for railway stocks. And if I was not so negative on the market, especially mid-cap stocks, I certainly look at them positively. But railway stocks, PSU companies, PSU engineering companies, even PSU banks, I think they are right on top of the list when we feel that we have a full-on correction and these stocks index correcting by 10-12% and these stocks correcting by 25-30%. Those could make good entry points because these are great businesses. As of now, and 2-3 years looks very good, but a lot of the valuation comfort is no more there. And therefore, I feel that you may not get a decent outperformance if you buy stocks at these levels. And it's always a bit of a issue if you buy and then you feel that a stock correct by 25-30% in the next few months or so. So from that point of view, it's just wait and watch for all these railway stocks.
Deepan, we leave it there. I believe you're utilizing the 3-day weekend.
Yes, going out of town.
Please check if the flight is on time, Deepan. We don't want you to wait too long at the airport. Huh?
I'll do that. Thank you, Nigel.
Okay, we'll speak with you next week, hopefully. Thanks very much for joining us and running us through all of those views. Have a good one. The markets, I think, slipped a tad bit more. We're now at the low point of the day. It's a full 200-point cut. What a week we've been having. There's no lack of drama, even though it's a 3-day work week, a 3-day market week, but just incredible amount of movement from the high to the low and on all 3 days so far. We'll take that break. We are back. We'll get you an exclusive chat with Sandeep Tandon, who runs Quant Mutual Fund. They're bullish on two things. They're bullish on PSUs and they're bullish on metals and mining. And they found a way to combine both. He's bullish on PSU, metals and mining. So that conversation coming up next.
Welcome back. Well, let's tell you about a few results that did come in earlier today. Tata Steel, those numbers look good. We had the EBITDA number that came in much better than what the street was working with. Well, let's run you through a few details out there then. The India EBITDA per ton, well, it looked much better. Came in at around 17,000 rupees. We were working with a number of around 14,550, but I had a chat with the management, and the details that we got was the EBITDA per ton included around 1,500 rupees of inventory movements, So that was one factor out there. And also in quarter 4 now, the EBITDA per ton could take a hit because steel prices have corrected by around 1,000 rupees per ton. Coking coal costs as well will move up by close to $10 per ton. So the reason that the stock is under pressure, despite such a big beat, is because, in fact, the street is a little bit skeptic about what's going to happen in quarter 4. Europe, well, it delivered a loss, but no one was expecting a profit. So that was pretty much in line. The management told me as well that they're looking at losses reducing in Netherlands in quarter 4 from quarter 3. And from quarter 1 of next fiscal, it'll turn profitable. Debt number continues to remain stable. The management says, yes, we'll be trying to reduce the debt, but they didn't give me a number out there. And also they go on to state that they're going to be focusing more on organic growth rather than inorganic growth, and also the benefits of the expansion at Kalinganagar that will gradually come on stream for FY25. So you'll have volumes that will get a bit of a tailwind. Numbers look good. Problem is the street doesn't believe that they can sustain in quarter 4. Explains why the stock is down.
Okay, fair enough. Nothing wrong with the numbers, as Nigel is explaining. By the way, there's a guidance cut from Syngene that's flashing on your screen as well. So, as we're saying, a lot of the mid-cap earnings that have come in the last 24 hours, not exactly lighting up the house. However, let's focus on one that is relatively better off, and that's PNB. Those numbers were on our screen just a while back. I think we've got Abhishek with us. Abhishek, this is not bad, right? Asset quality seems to be improving. Loan growth looks decent as well.
Well, it's one of the best numbers on asset quality that you are seeing in last 8 to 10 years of gross NPA and net NPA ratio. In terms of the performance with respect to PNL, the NI is above our poll and PAT is largely in line with our poll. So a good set of numbers coming in from PNB Housing. Loan growth remains healthy at 14.5% YOY and about 3% sequentially. The deposit growth is the weak link over here, growing at just 9.35% YOY and about 1% quarter on quarter. The operating efficiency or cost to income ratio that they call in the banking sector, that is one of the best in last 5 quarters, coming in at 51.2% versus 52% sequentially. We have seen cost to income ratio rise for PSU banks on account of the wage provision revision that they have to make. Over here, the cost to income ratio has actually improved. There is sharp improvement in the overall asset quality. Gross NPA absolute value is down 7.9% quarter on quarter. Net NPA absolute value is down about 33% quarter on quarter. Looks like either they might have done write-off or sale to ARC, which might have helped in controlling or reducing the pain in the portfolio. Gross NPA ratio at 6.24% is the lowest that you are seeing in last 34 quarters. Net NPA ratio, perhaps over the last 9 to 10 years, it's the first time that I'm seeing it below 1% for PNB. Back to you.
All right, Abhishek, thank you very much for that. So that's PNB coming through. Syngene, by the way, has cut its FY24 revenue growth guidance, as we just have been sort of reporting on it. Stock's not selling off more, about 1.75% down is what you have right now. Now, public sector stocks have been all the rage for the last so many months now. And even on a market which is down 200 points in the Nifty, that's the pack which is really charging ahead. Now, most of the interest, one has always assumed, comes from retail investors, small shareholders. But institutional investors, mutual funds are also getting behind this theme in launching schemes and attracting a fair bit of flow. Hormuz has looked at what institutions are doing and how many schemes and from which houses they're available. Hormuz, take it away.
So there are 4 such schemes that have been launched by fund houses that predominantly are focused on PSU stocks. Now, the 4 of them include the Aditya Birla Sun Life PSU Equity Fund, the ICICI Prudential PSU Equity Fund, the Invesco India PSU Equity Fund, and of course the SBI PSU Fund. Now, what has happened here is that there are some commonalities in all 4 of them. One of them being that majority of their exposure, of course, is towards equity. And I'll start off with the Aditya Birla Sun Life PSU Equity Fund. The AUM as of date is around close to 1950 crore rupees, and over the last 12 months this fund has returned 71% to its investors. Now, 91% exposure, 91% exposure is towards equity, and the remaining 8% surprisingly is towards cash. So there is a cash holding there as well. Now this is according to Value Research. Now among the top 5 holdings, NTPC is the top holding with them around 8% of their assets. Coal India is one, SBI is another, ONGC and Bank of Baroda form their top 5 holdings. Now the interesting bit here is that SBI, despite being an underperformer, is one of the largest holdings in all the 4 schemes. Now ICICI Prudential is the other one, the AUM around 2,000 crore rupees as well. Around the last 12 months, the fund has returned 61%, 91.6% allocation to equity, and 1.5% exposure to debt as well, and the remaining being a cash exposure. And here as well, SBI is the top holding. The last 12 months, India's largest lender has returned only 7% to investors, and yet it is the largest holding of this fund. 15% of their assets belong to are allocated to SBI, and the usual suspects again, NTPC, Power Grid, Coal India and ONGC form the top 5 holdings here. The Invesco India PSU Equity Fund is the smaller AUM size, around 700 crores, similar returns, 62% over the last 12 months, 95% exposure towards equities and the rest towards cash. And here as well, NTPC is the top holding, and the addition here, the surprise addition here is HAL. There they have a 6.3% allocation of the total assets, and that stock has returned over 130% over the last 12 months. And lastly, the SBI PSU fund, which has an AUM of around 1150 crores, that has returned around 65% over the last 12 months. Around 97%, the maximum exposure among all the 4 funds towards equity is in this fund, and the remaining is towards cash. And as unsurprisingly, SBI is the major holding here, but the addition here is Hindustan Copper, which is 5.5% of the total assets. That stock has returned 120%, and BHEL, that makes an entry with 180% return, and it is 5% of the total assets of this fund. But surprisingly, neither REC nor PFC, 2 of the top performers of the Nifty PSC index, feature in any of these funds. Only 1 out of the 4 schemes has an exposure to PFC, and only 2 out of the 4 schemes have exposure to REC. So these are the 4 funds that are PSU focused, around 60 to 70% returns. The stocks have returned far more.
All right, Hormuz, interesting data there. And, I was hoping to see all these REITs and railway PSU stocks, etc., but it's kind of hard for them to be because we only looked at the top 5 or 6, right, holdings. So just by sheer weight, they'd probably, if they'd probably be somewhere lower down. But thanks very much. Interesting data on, institutional ownership. 4 funds, 4 PSU-focused funds is what we have. Now, let's actually listen to Sandeep Tandon. He's the founder and CIO of Quant Mutual Fund. They got into this entire PSU space some time back. Almost a year and a half out back. Got into PSU banks in a big way, paired their positions there, still invested in railways. They're kind of rotating out of, but still very bullish on the metals and mining theme. So PSU is still very much the focus there, with between 18 and 25% weight in many of their funds. Listen to a slice of this conversation.
So from India perspective, if I look at Prashant, the way right from 2023, I said that years belongs to neglected zone stocks, most hated zone stock. If you really look at from a growth versus value debate, which keeps on happening globally, the cycle which started in August 2012, the growth at any price, that lasted till September 2021. Okay, the cycle peaked out. After that is the value thesis which has come back. Now I'm not saying that entire move is going to be a linear move. Okay, within that you will see some cyclical up move or cyclical down phase also. But our portfolio is now more pro value. Why I'm saying that? Because
which is hard assets.
Hard asset. Okay, we strongly believe that the perception which was there, okay, for these, if I have to, let's say in September 2021, there was a euphoria. And if you dissect the euphoria, you find the euphoria was in new age technology company, growth company, not in value, not in infra name. So I think that
but we've come a long way from there.
Yes, but still, this, our view is that value as a thesis has a potential to last for a decade. It's a decadal view. Wow. Okay, and then look at the PSU moves. PSU is the classic representation of value thesis. They were beaten down.
Is that the highest weighted sort of space?
Yeah, for us is a very large weightage. We are relatively
if you define by ownership, would you say PSUs are your...
Yeah, it may be closer to, some schemes are 18 to 25% of that portfolio will be in PSUs.
Okay, and do the moves make makes sense. And we're talking about banks, or we're talking about PSUs across the board?
We have banks also, but the percentage is very small as compared to 2 years back.
Okay.
Now, earlier 2 years back, the banks...
So PSUs ex-banks largely?
Largely ex-banks, ex-banks.
But there also, I mean, some of the moves have been phenomenal. Railways as a sector, there's defense as a space.
We have a large ownership in railway stocks in our portfolio.
And you're comfortable owning them?
Comfortable. Because you have to look at the thesis which you are bringing. When something gets changed, okay, when you say one perception of the most admired territory gets shifted, you know, the shift, even let's say 10% of the money shift from admired territory or the most admired stocks towards value stock, the money is very, very large. Like when I say, let's say, why I'm slightly more cautious on US, we always say that developed market risk appetite has peaked out, okay, and liquidity will shift. So how money shift from high risk to low risk environment? If 10% of money shift from US to Asia and India in particular, there is tsunami out here. Something similarly, look at in last many years, last 10, maybe 1 decade, a large portion of concentration was confined to these admired territory stocks. If 10, 20, 30% money shifts from that territory to this value as a thesis or neglected zone stock, there is tsunami, okay, and we are already witnessing that phenomena happening. And where is the over ownership, okay, as compared to 2 years back, they were neglected, hated zone, but they are still not reached the admired zone.
But valuation-wise, I was looking at names like RVNL, etc. Now they're trading at 40, 45 times.
So I'm saying
earnings,
you have to do sector rotation, stock rotation. I'm not saying that one particular stock you have to participate. Like we were very early in PSU banks, we monetized that opportunity. Now we are somewhere else. So the sector rotation thesis, stock rotation thesis, you have to play to manage your risk.
But you're saying there is enough to rotate into.
Yeah,
because sometimes one feels that rotation to सब तो हो गया अभी कहाँ rotate करें?
I will not take the name. Look at the top largest PSU companies. I'm telling you, if you look at top 3 in terms of market cap, where is the ownership?
Right.
The largest public sector enterprise, the free float is 3.5%.
Not banks, right?
Not bank. It's not a bank. But where is the ownership? Okay. It's one of the large bank company available, not valuation-wise very expensive. I'm just giving example. And similarly,
ONGC and
they're Coal India, they're ONGC, they're LIC. You know, top 3 names are these 3 names you will get. Okay, where is the ownership in these names? On a relative basis, absolute basis.
You own all 3?
Yeah, we own all 3.
Okay.
Our portfolio is already disclosed, so we can talk
and
about
bullish
it.
about.
Yeah, we are quite constructive on this space. Okay. See, we believe metal and mining as a thesis, which we started in 2023. I think will continue in 2024. PSU as a thesis will continue. So then you look at PSU and mining put together, and a PSU mining company will do even better because overall PSU we are constructive as a theme. Then we are constructive on mining from a global perspective. We are very constructive. We think the mining
I think Hindustan
is
Copper is something that you own in your funds.
Yeah, it is one of the large holding in our fund in a small cap. We bought at very early stages, but we are holding it for the last 3 years
and
now.
that came off a macro kind of a call.
Yeah, for macro call.
One name which you I don't think have own in your portfolio is HDFC Bank. I mean, why is
no,
that?
it's not been. Currently, we don't own it.
I mean, you used to own it.
Yeah, we used to own it.
But private banks is something which, I mean, the street is extremely bullish on. It has been bullish for a while, but that has not worked for some time.
So this is the same answer I'll give you. If you look at the pure valuation aspect, valuation was attractive. Everybody was talking about it. It was a very consensus trade for a while. But if you start looking at the risk appetite data or liquidity analytics for the sector as a whole, then you realize some of these names actually peaked out way back in September 2022 itself.
When you say peaked out, you mean
reached out a peak. Okay, when I say peak out, not in terms of prices, like risk appetite was the highest between September 2022 till September 2023. So risk appetite has peaked out, which means there is no urgency to buy for anybody. Okay, liquidity cycle is actually shrinking. Okay, so if liquidity is declining, so it's a bad combination. See, otherwise when liquidity cycle rises and risk appetite is rising, you make more money. When otherwise it happens, okay, so risk appetite peaked out, liquidity shrinking is a reverse combination. So that's the area we try to prune out. So we maybe I think overall we have only 3.8% weightage in the banking as a whole, in the entire portfolio, depending on scheme to scheme. So we are grossly underweight on the banking side.
And that has worked wonderfully well for you.
So far it's worked very well.
It is what.
But again, it's a data-driven approach, not on the.
And if the data changes, you will.
We have no problems.
But as of now, it's not showing any signs of.
So if you ask
changing
me
or
from
turning.
a near-term perspective, maybe we have seen a massive sell-off, so maybe pullback rallies can be there. But to take a decisive call, I don't think they have reached those neglected zone where we get like what was pharma in February, March, okay, or IT was in September. I don't think they have reached that phase where we will say go all out and increase the exposure. And again, it's a consensus trade, grossly overowned space, okay. So anyway, we don't mimic indices. So we are very active money manager. So I look at industry closely. A lot of people look at closer to the benchmark allocation. We don't do that.
Got it. Is the market in fine shape, Sandeep, or you think we should be ready for a little more volatile 2024? I mean, ups, not just ups, which everyone is just used to, and some downs as well along the way. What's your sense?
So let me give you a larger thesis. We have been saying India, this decade belongs to India, maybe half century belongs. Manufacturing as a cycle, larger thesis I'm talking about, looks very good to us. Anything, and again, the manufacturing is a very large thing, manufacturing, infra, as a space is doing very well. But again, as compared to maybe 2023 return, because everybody was very skeptical in the beginning of 2023, and obviously returns are far superior, you may not get something similar performance. But we are still very constructive on the entire India space. I have been talking about that we are in bull run, very decisive bull run. We are still in bull run. But easy phase of bull run is over.
So you crossed the 50% mark.
Maybe in certain sector, maybe certain stocks could be answer is. But if I have to look at summarize in the thing, I think maybe in 2024, at least I expect 24,000 nifty. That's sort of the minimum what I'm expecting this year. It's still a good growth in terms of return perspective. Is a good number. I don't think we have seen a stage which is very classically euphoric, where we need to be worried about. But stock rotation, sector rotation is the thesis which we play, and that really help us in reducing our.
Okay, interesting chat over there. But let's talk about SBI Life. The stock has slipped 2% after reporting numbers. Yash joins in. Yash?
Well, Rima, one thing is very clear that the problem around AP or premium expansion and margin expansion is a problem across the industry. But what I feel is that SBI Life seems to have handled both those issues a little better than HDFC Life and ICICI Pru Life. Speak about the top line, the total annualized premium equivalent. It's a slight beat when compared to the CNBC-TV18 poll. It's coming at about 6,130 crore. We were expecting it to be at 6,086 crore. It's up at a decent 13% on a year-on-year basis. Value of new business, again, as I said, that those two problems have started impacting the numbers from here on. It's coming at about 1,680 crore. We were expecting this number to be about 1,722 crore. It's again grown at about 11% on a year-on-year basis. When we speak about margins, of course, margins have contracted. It's a miss as compared to CNBC TV18 poll as well. Margins have come in at about 27.4%. We were expecting them to be at about 28.3%. On a year-on-year basis, they are down about 40 basis points. So, of course, the problems are there. Nobody can deny them. Companies are facing it difficult to expand their premium because of, the restrictions on the sale of high-ticket policies. The margins are not expanding because there's a higher demand for ULIP, which is a lower margin product. But still, as compared to HDFC Life and ICICI Pru Life numbers, SBI Life seems to have handled both these issues better.
Okay, all right, got that. Thank you, Yash, for the details there. That is SBI Life at the end of Q3. We will take a quick break on that note. Come back on the other side. We will tell you all about the buzz in dealing rooms today and then get you some final trading ideas as well before the week closes out.
Well, take a look at the screen. It's 3 p.m. and we're getting into that expiry hour, and that explains why we're seeing a big recovery from the day's low. Pull up a few stocks. Hindalco has spiked up from the day's low. L&T, that's the larger weight in there. Big recovery is what we're seeing. So pull up L&T and ICICI Bank. Both of them have seen a sharp spike up from the day's low, and the Nifty Bank as well is 400 points off the day's low. So there's a bit of an expiry-related factor that's played out here, and that's why the Nifty has done a quick 80 points as we speak. But a good time to get in, Nimesh. Nimesh, looking forward to that weekend, Nimesh. But tell us, what are you picking up in terms of dealing room chatter?
Well, Nigel, it's expected to be a volatile day because of the expiry. We have a truncated week as well. But, a lot of earnings have been disappointing. And that's been a key reason the markets have been dragged again in today's trade. Well, the financials look a bit weak, but contrary to the screen, I understand there is a bit of buying interest back in the private bank stock from the larger FIs. So that's the overall sense from as far as flows are concerned. There was a large block in PNB housing, but that's largely like an internal trade, so it won't impact much in terms of the actual flows, so to speak, from the FI. So that's a bit of a clarification. And again, the PSUs continue to outperform. Select PSUs have done well again in today's trade. So that momentum in the PSUs continue, but I think the volatility is largely because of the expiry today. But again, in terms of earnings, only select pockets have done well. Largely, it's been a bit of a disappointing quarter in most of the sectors and stocks.
By the way, it's an interesting development on Zomato coming up on the screen. So Zomato has managed to get itself a payment aggregator license. Stock's a little volatile anyway. It's had a great run. I guess, Nigel, then what this means is that you can not just Zomato me some nice snacks for the evening, but Zomato me some money as well. But I don't know, it's a competitive landscape. You have a lot of payment aggregators already out there. So not quite sure how this fits in with their business plans. But that's interesting news nonetheless.
I think we'll just stay simple, go for a drink later, post the show. But let's get back to Nimesh. Nimesh, what are the stocks you're picking up in terms of news flow?
Well, Nigel, in terms of individual names, the first stock on my list is Sangam India. In a weak market, that stock is up 6%. Good volumes as well. There is a large block in today's trade. And I understand a single FI investor was a buyer in today's block, and some clutch of investors, including some HNIs, they sold in a block deal. So that's Sangam India. The second stock is ICICI Securities. This is interesting. That stock has seen a lot of volumes in today's trade. So expect high delivery volumes. Some bit of FI interest seems to be back in this particular stock. And remember, there is an EGM which is impending for a proposed merger with ICICI Bank. Given the kind of stock is trading at a premium now, looks like there could be some development as far as the merger is concerned. So that's the reason why ICICI Securities is buzzing in trade today. Third is a couple of stocks, both from the MSCI point of view, both BHEL and PNB. PNB, of course, the results came today, but BHEL is buzzing in trade, largely in anticipation that maybe the stock is going to get added to the MSCI in the Feb review, which will come on 14 Feb. So that's the reason why BHEL is buzzing. And the last one is Indiabull Real Estate. While there is a board meet for Indiabull Housing for a rights issue, even Indiabull Real Estate is buzzing, and the city is anticipating some corporate development in Indiabull Real Estate as well.
Nimesh, ICICI Securities, right? I mean, this is this has been a contentious issue for some time.
Yeah.
Anything else you're hearing?
So, Prashant, one of the feedback is that maybe the merger may not go through because the minority shareholders may likely oppose the merger with ICICI Bank. If you look at the merger ratio, 67 to 100, which currently at this point suggests that ICICI is sitting at a premium to ICICI Bank. So, at least the market is perceiving, and the stock market is indicating that maybe there could be some question marks. Either the merger doesn't go through, or the merger ratio gets revised in favor of ICICI Securities. And remember, ICICI is the only stock in that broking space which has relatively underperformed in the last 6-8 months. Look at Motilal Oswal, look at even Angel One. They all have rallied pretty hard. Even ICICI numbers were quite good, but the stock has relatively underperformed only because of this merger issue. If that gets resolved and if the merger gets called off, maybe the street is anticipating that you could further see some re-rating in ICICI Securities.
Okay, interesting list as always. Thank you very much for putting the spotlight on that. By the way, the 3 p.m. expiry move seems to be taking place. The Nifty at 3 p.m. was below 21,300, and in a span of about 10 minutes, it's gained close to about 50 odd points. It's 21,350. The Nifty Bank too has seen a recovery of close to about 400 points from the session low. So trimming losses there. Names like ICICI Bank, Titan, L&T, Hindalco, these are stocks which have moved up as we speak. HDFC Bank, though, continues to languish under pressure. The improvement that we're seeing in banks is courtesy names like an ICICI Bank, and I think even an Axis Bank is seeing some bit of buying emerging. Nagraj Shetty is now with us for a few BTST calls, for the long weekend. Nagraj, afternoon. Thanks for joining in. What have you made of the price action today, the week, and what does it tell you? And any trades that you have?
Yeah, right now market is showing a weak trend. Even some sectors stock-specific action is continuing. On the index front, at the higher levels, I was discussing in the afternoon at the higher levels, facing strong resistance around 21,500, 600 levels. A bit of recovery seen towards the end, and I'm expecting at the higher level we could see some selling emerging from the highs. And at the same time, there are some stocks showing some buzz. And if you look at the sale, the stocks has showed a false downside breakout recently and bounced back sharply in the last couple of sessions. And looking overall chart pattern is looking positive. I'm expecting this stock to move up further, and the next resistance to be watched is around 125 levels. This is the one which is showing some promising move in the during the volatile broader market.
Okay, we've got the numbers out from JSW Steel. That first line on the PAT front looks absolutely robust. In fact, a significant handsome beat over the expectations. Tata Steel, remember, had a good showing as well on EBITDA on margins. And the start for JSW obviously is very, very positive. Stocks already moved up in positive territory. Right now, only have the profit line, and then we'll get to Nigel in a bit and discuss the rest of those earnings as well. But let's bring in Amrish Baliga into the conversation. Amrish, good afternoon. Thank you for being with us. Since we're on the subject of steel, and then I mean, good showing by Tata Steel and JSW, from the looks of it, it's looking decent, at least as of now. What would your take be on ferrous stocks, the large cap names?
No, I think the earnings have been, I suppose, hold on. Have been going ahead, increase costs. So that could, but I don't see much of a downside. And at the same time, the steel as well, in fact, rallying from here. So I would possibly hold in Tata Steel.
Yeah, Amrish, we'll just come back to you. By the way, we've got getting the other numbers that are up for you on the screen. So on the top line, it's more or less in line. The beat that has come in there is because I think of lower operational costs, and that explains why, if I saw that number correctly, on the EBITDA front, there's a good 500 crore beat out there, 500 to 600 crores. So I remember some part of the street was talking about this. Such a big beat on Tata Steel's India business. So the street was baking in that maybe the other couple of companies as well that have a similar mix should do well. And JSW Steel has a higher amount of flats. So that could explain why, in fact, that's come up higher. In fact, if you look at it, there's a good growth on the top line. And the power and fuel cost is sharply lower on a year-on-year basis. So that's one reason that's playing out there. And I think that's the primary reason why, in fact, we are seeing this big beat in terms of the EBITDA front. And that's why the margin number has come in at around 17%. We were working with mid-teens. Rakesh Arora of GoIndiaStocks.com joins us on the show. Hi, Rakesh. Well, the initial numbers that we have on the screen is top line more or less in line, but it appears the costs dipped more than anticipated. And that's why that's a beat out there. Your reading.
So, Nigel, I think, there's a little bit of lag between, raw material prices going up and or going down and being passed on. So I think that's where the beat has come in. But I think, going forward, steel prices are lower. Iron ore prices have moved up. Coking coal prices have moved up. And as Tata Steel was mentioning that, even in their results, almost 1,500 rupees per ton was just because of inventory gains. I think same is the case with JSW. And let's also not forget that JSW iron ore costs are much more linked to international prices. And they'll have a bigger impact getting into Q4.
Okay, we've got Abhijit Bora also joining in to react to the JSW numbers. He's from Sharekhan. Abhijit, you want to give us your initial take and what would you advise on the stock now?
Yeah, firstly, we have a neutral sense on the metal space and we have a reduced rating on JSW Steel. In terms of the results, if you see the consolidated PAT came at around 2450. Our expectation was around 2100. So there is a slight beat in terms of the overall PAT. There was a slightly higher standalone EBITDA and also slightly higher, better performance from the subsidiaries. So there is a slight beat in the overall PAT of the company. We are waiting for further details.
Okay, all right. There are a couple of more details that we're getting up for our viewers on the screen. And the Bhushan Power and Steel asset, well, that's done quite well. The EBITDA number has come in around 780 crores. So, as Abhijit said, I think part of the subsidiaries as well have done quite well. So the numbers go down as a beat. The costs have dipped more than anticipated, and you have some of the subsidiaries that have done better. Rakesh, it's almost market close. So final word from you before we let you go. Between the two, JSW Steel and Tata Steel, as well as SAIL and JSPL, what would the preference be? Both these two have delivered better than expected numbers, but valuation comfort, I think, is in the other two.
And also, Nigel, that, Tata Steel is slightly more consolidated and integrated for iron ore, where prices have actually moved up quite reasonably, even in India. As you saw, NMDC yesterday raised prices by 400 rupees. So I think integrated players would be better placed as compared to JSW going into Q4.
Okay, all right, gentlemen. Thanks a lot for joining in and giving us those details. So the big headline that comes in there is that JSW Steel's operating profit is better than anticipated. You have a couple of the subsidiaries that have done well, and a couple of them, the larger ones have done well, because JSW quoted actually the profitability on a sequential basis is a little bit lower, while on a year-on-year basis, JSW quoted's numbers look quite good. So the numbers are a beat, but sustainability of these numbers will be tracked. For the time being, slip in a short break, come back, count your focus on markets, and we'll take you through the end of this expiry.
Okay, welcome back. You got the market, which is come up very, very nicely from the lows of the day, buying down 200 points now, about 120, 125 points off the day's lowest point is what we have. Amrish is with us. Amrish's pick today is life insurer, HDFC Life.
Yeah, Prashant.
Amrish, last time, you know, the budget was a significant event for these life insurers, and not in a good way. Unlikely something similar will happen again, but why do you like this one?
Yeah, I mean, I think it's unlike to have anything negative in the budget this time, because end of the day, the budget, the main budget will be in possibly June, July, and this is more of a vote on account. Now, why I like HDFC Bank, see, basically it's the largest life insurance company, among the largest, and it has about 19.8% market share, and it's number 2 in terms of overall new business received premium. Look at the AUM, it's about 2.8 lakh crores, and the 13th month persistency ratio, which is one of the measures for life insurance companies as to how well they're doing, that's about 86%, which is quite decent. In fact, they have more than about 2 lakh agents, about 90 banca partnerships, and other than HDFC Bank branches, I mean, they have 500 of their own branches. The focus is on tier 2, tier 3 cities and towns. Q3 was anyway a bit of a disappointment, and that's why we've seen a correction in the stock along with the negativity which is there in the BFSI space, other than the PSUs. But I think this is an opportunity. Because look at the superior product mix which they have, a strong distribution channel. I think this will drive the growth going ahead. And we should remember that India is still a very underinsured market, about 3.2% penetration. And next 10 years, we will see the insurable population actually go up from 50 crores currently to about 100 crores in the next 10 years. So HDFC Life, I think, has that huge opportunity, and it quotes at less than about 2x embedded value of FY26. In fact, my expected EPS for 26 is 10.5. And with this, my target is about 750, which is a decent return from the current levels.
Amrish, I remember once chatting about Tata Elxsi with you. Company reported their numbers this week, a bit subdued, lower than street expectations. And the stock is expensive at 40-45 times forward multiple. Now you're getting the stock about 8% cheaper this week, and from the beginning of the year by nearly 13%. So would you go out and buy it at 7,650?
Yeah, surely, because last time I think when we spoke, I had given a target which was close to about 9,100. It went to those levels. So those who had bought at that time, I'm hopeful they would have booked profits. I think this is again an opportunity to buy this at lower levels. And in fact, because of these earnings and possibly with the market correction, I'll not be surprised if we can get Tata Elxsi at closer to about 7,100 to 7,200 levels. So this is a buying opportunity. Again, it could be a wait of the next 2 quarters, but I suppose we'll again see those levels of 9,500 levels. So I think it's a great opportunity now.
Okay, all right, Amrish. We will have to wrap it up on that note. A little short on time today, but thank you very much for joining in and giving us the perspective on all the stocks that we've discussed. Well, the market is going to end looking not that bad at all. Imagine the Bank Nifty, which was down a whole 1.1%, has had a very decent recovery. So it seems to be springing to life getting into this long weekend. And if I talk about some of the movers and shakers, just in the last half hour or so, the recovery is quite visible on stocks like, ICICI Bank anyway, better of the lot. Let's pull up some of the others as well. Pull up HDFC Bank, for instance. Pull up Axis Bank. Still in the red, but they've cut their losses, helping the Bank Nifty also pare down some of the red on the screen. Having said that, the red side does comprise of Tech Mahindra, weakest stock on the Nifty, 6% down. Cipla, which was losing some momentum after yesterday's big surge. And Bharti Airtel is the other one, which is down about 2.5%. Those are some of the big names on the Nifty. On the gaining side, Bajaj Auto, 5% in top gear. And how?
Well, ACC's numbers look very, very good, as we mentioned earlier on the show. And in fact, that stock popped up close to around 10%, goes home with a big gain out there. And it had a positive rub-off because Ambuja Cements as well was up close to around 7%. Remember, Ambuja Cements is the promoter of ACC Cement, so that explains why that stock is well run away. Now the street is looking through that. Maybe, in fact, both of them have got their act together. India Cements, well, it took heart from the fact that ACC's numbers are so good. The stock had corrected close to 15% from the recent peak, but today it popped up in trade, so that did well. Nalco, overnight you had aluminium prices that were quite firm, and it's a PSU and it's in mining, so the street likes that. So that stock as well ends with solid gains. On the flip side, you had stocks like KPIT, Loris, HBCL, all of them under some pressure. But guys, I think what was important today was the Nifty Bank, second day running, went to the 200 EMA and managed to bounce off that mark. I think that's going to be a very, very crucial level on the Nifty Bank and in turn on the Nifty.
Well, there goes the bell, and the Nifty closes at 21,378, a 75-point knock on the Nifty, with the sensex down 310 points. And just a quick tally of the week gone by, it was a truncated week. The Nifty ends with a cut of 0.9%. The mid-caps end with a cut of 1.7%. And the big drag has come in terms of the banks. The Nifty banking index down 2.5%, with private sector coming under pressure. But with that, it's a wrap on Closing Bell. Editors Roundtable comes up next.
For more news and updates, all you need to do is follow CNBC TV18 on all of our digital platforms.